Well, thank you for joining us on the National Real Estate Cafe, where you get your daily dose of real estate market updates. And today is a good one.
Yeah, well, we're celebrating 7 years of the Don and Gino Real Estate and Finance Show. Yeah.
7 years, and we've probably been doing the National Real Estate Cafe for about 3 years now.
That's right. So you can find out more by going to donandgino.com, and you can get these on your phone every single day by texting NREC to the number 58885.
Yeah, and check out our YouTube channel. Probably over 2,000 YouTube videos since we started this, keeping you in the know. And today we're going to let you know, where do we think rates are going. So when we show you this dot matrix chart, remember there's different interest rates. When the Feds raise interest rates, that doesn't mean long-term. That means credit card debt, HELOCs, equity loans, I should say, and credit card debt. Those are short-term rates. Long-term rates are controlled by mortgage-backed securities. Those have remained pretty strong, pretty good right now. They haven't gone up too much.
Yeah, they're holding pretty well. But let's take a look at this chart, which talks about Fed funds rate. So there's a little bit of a discrepancy here because the Fed funds rate is what's called the overnight lending rate. That overnight lending rate is the price at which banks lend money to each other for short term. That usually then prime is 3 points above that. And
Right.
so the prime rate, which is at what they lend to consumers with, is usually right now it's at 4.75, and it's been rising steadily, and there's still a few more rate rises in the menu for this year.
So what that means to you is 4.75. So that could be your base rate at prime, or a lot of the banks add on what's called a margin. Could be as little as 0.25%, could be as high as 10%. You never know.
Right. So let me give you a pretty good example, right? So most home equity lines of credit are tied to prime. So if you have a home equity line of credit that's tied to prime, prime went to 4.75, and the majority of them have a margin of about 2%.
About 2%.
Yeah, 2.5, 2.25,
So you're
but
looking
on
at
average about 2%.
6.5, 6.75 right now.
Right, which is not a bad rate. Remember that historically, 6.75 is not a bad mortgage rate, particularly for a second trustee.
Okay, so if you look at this chart, how does 8% sound?
Ugh. Starting to sound a little sticky, a little bit towards the upper end of the range.
Right. So that's why I want to show you the chart. Basically, this is called the dot matrix. This is what the people that make the decision on whether we're raising interest rates or not, what they feel the rates are going to be at the end of this year, in 2019 and 2020, and then beyond. And you can see that they predict that rates could potentially go up another 1.25%.
Yeah, so if they go up another 1.25%, what does that mean to you? So speak to the people that you work with, the people in your financial markets, and see what instruments do you have that are tied to prime. Like I said, a home equity line of credit is probably the number one factor that you need to be concerned with, because it could be a very big loan, $200,000-$300,000 loan.
Correct.
You could probably have car loans tied to prime as well. Those are usually, you've already agreed on some sort of fixed rate, so it's pretty odd that would be. But credit cards is one that'll sneak up on you as well.
Yeah, so you heard it right here in the National Real Estate Cafe. Get these sent right to your phone by texting NREC to the number 58885, or find out more at donandgino.com.